When you see real money go up, it affects you. The market goes up and goes down. These are like that, but on steroids. Today we're going to talk about contract for differences, otherwise known as CFDs. You would have heard this term many times when you're looking at brokers or when you're thinking about trading. Now, specifically, CFDs are a type of trading where you take a bet on the market. So just think about buying shares. When you buy a share, you essentially buy a small percent of a company, right? You use cash to buy a small percent of an asset, which is a company, right? Now with a CFD, what you're doing is essentially just taking a bet with your broker as to which price the market's going to go. Think of it like this: buying shares with cash, this is the leverage you have. The market goes up, the market goes down. Where if you take a bet with leverage, this is how the market goes up and goes down. So essentially leverage, it means that you're taking on more risk, which means you can make more money, but you can also lose more money. So it's a very different type of trading to shares, because when the market goes up within the share market, you can choose, do I want to hold, do I want to sell, do I want to sell an options trade, do I want to sell a covered call? You've got options. Where when you own a CFD, you actually don't own anything. That's why I'm not the biggest fan of them, to be honest. But as a beginner, you should know what they are. They can be used as a tool. If you understand risk management, they can be used as a way to trade the market. The difference between CFD betting, that term betting, and gambling is that gambling is one of those things where supposedly you don't have any risk management. And so, there's a very fine line. There's a very fine line between gambling and CFD trading, because some people do just, for usually emotional reasons, they can't regulate the risk and they just keep over trading. And quite frankly, if you're a beginner looking to get into trading, I know you may have heard this many times, but psychology is kind of most of it. Because intellectually, you can be super intelligent. You can learn the chart patterns. You can understand the market and the macroeconomics, and you can understand the fundamentals and the sentiment analysis and all this other stuff, which I will make more videos about in the future. But if you don't have the psychology, this won't make sense until you've started trading live money. When you see real money go up, it affects you. When you see real money go down, it messes with your head. And this is what I want to say. CFDs are like that, but on steroids. They usually do it with currency. But the thing about CFDs is you can trade CFDs on pretty much anything. If you can think of it, there's a CFD for it. That's essentially CFD trading. If you can think of a market, futures, options, Bitcoin, commodities, there's a market for that somewhere, and someone's doing a CFD bet on that. And also CFDs can be used kind of as a hedging strategy as well. Hedging is another complicated topic that I'll get into in another video. But essentially I'm trying to give you a nice overview, if you're a beginner, about what CFDs are. Thank you for watching. When you see real money go up, it affects you.